Why did the Fed add 4 new voices to its Insurance Advisory Committee, and why should investors care? Because what happens inside insurers' balance sheets can ripple through credit markets, interest rates, and liquidity that affect your portfolio. The Federal Reserve appointed 7 members to its Insurance Policy Advisory Committee, with 4 newcomers joining. This is not headline theater. It is the central bank tightening its link to a sector that touches corporate bonds, structured credit, municipal finance, and long-duration liabilities. The goal is better insight into risks that can echo across markets when financial conditions shift. IPAC is an advisory body, but its vantage point matters. It helps the Fed see how insurers react to rate moves, how they price and fund promises to policyholders, and how investment allocations adjust when yields and spreads change. That lens feeds into supervision of insurance holding companies and supports the Fed's broader mandate for financial stability. Consider how insurers operate. They are major institutional investors with portfolios that lean heavily into corporate credit, munis, securitized assets, and alternatives. Their asset-liability math is sensitive to rate cycles. When policy rates rise and stay elevated, liability values fall, reinvestment yields improve, and risk appetite can shift. When volatility picks up, liquidity management and collateral needs become front and center. IPAC's conversations can surface these dynamics early, helping the Fed gauge transmission into bank credit, capital markets, and the real economy. Recent conditions have been a stress test. Elevated inflation, higher for longer rates, and market swings have sharpened focus on interest rate risk, valuation and accounting changes, liquidity under stress, climate and catastrophe exposures, operational resilience, and cross-border supervision. New committee members bring perspective from life, property and casualty, and reinsurance, which broadens the view on capital, liquidity, and risk practices across business models. What should investors watch next? Expect continued discussion of how persistent higher rates interact with the credit cycle and funding needs for long-duration promises. IPAC can illuminate trends in private credit allocations, exposures to commercial real estate, and the use of structured financing. Signals here can foreshadow moves in spreads, demand for high-quality collateral, and the tone of primary issuance. The practical takeaway: track how insurers talk about duration, liquidity buffers, and asset mix in earnings and regulatory filings. Shifts in those levers can influence credit availability and market liquidity you rely on. Read the full article at finlitica.com. Quick reminder: this is general information, not financial advice. Your money, your decisions, so always do your own research.